Hello. Buffer stock schemes and buffer stock agencies who run the buffer stock schemes. Well, the purpose of these buffer stock schemes is to focus on a particular commodity, could be coffee beans, cocoa beans, could be a metal like tin, and try and stabilize the price, because commodity prices tend to fluctuate far more than the prices of manufactured goods. Commodity prices fluctuate, and this is very damaging for the suppliers who can't react quickly. They tend to suffer from inelastic supply. So they've got a great incentive to try and stabilize the price of the commodity. And one of the ways they do it is with a buffer stock scheme, often involving governments as well as the very largest of suppliers. And here's how it works. The buffer stock scheme focuses in the market where this is price, this is quantity, and where there is a demand curve and supply curve. They focus on, they set up and they try and establish, first of all, what is their optimal price, what is the best price, the stable price, the intervention price, they call it. The intervention price, let's say that intervention price is here. I'm going to call that the intervention price. They promise to act whenever the price deviates from the intervention price. Whenever the price falls below intervention price P, whenever the price is below that in the market, the buffer stock agency buys the commodity. They buy it when the price is low. So if the price, for some reason, there was an excess supply, let's say this is, I don't know, cocoa beans, and there was a super bumper harvest, just the perfect climate, no bugs that year, eating the little cocoa beans, leaves or whatever, and it just collapses, the price just collapses. Now, that would normally ruin the cocoa bean suppliers. But if the buffer stock agency is willing to step into the market because the price has fallen below the intervention price and boost the price by buying, they may be able to lift the demand to D2. That's the intervention buying, driving the price back up to the intervention price. Then they've got a store of cocoa beans. They've got a store of them, ready for when the price goes too high. If the price is too high, they release their store of cocoa beans, and that lowers the price. So let's imagine the next year there was a terrible shortage of cocoa beans, and we're back on this supply curve and this demand curve, the price was too high. They would release the store of cocoa beans they previously bought, and that would raise the supply and bring the price back down. So in essence, a buffer stock agency is always aiming to push price towards this intervention price. When the price is too low, they buy it. And they buy, that adds to demand and pushes the price back up. When the price is too high in the market, they sell, which increases supply and lowers the price. They're always buying or selling to drive up or lower the price. Well, that in theory is how it should work, but buffer stock schemes usually fail over some years, and they fail for three reasons. Number one, these markets are huge, and it would take vast buying and selling to really influence these markets. And very often the financial commitment is not there. They don't have the money they don't have the money to influence the market. Secondly, the storage of the commodity is expensive. Some of these commodities have to be stored in very specific conditions. And ultimately, they may go off, especially commodities which are agricultural products like beans. They may go off. But just the storage cost of vast quantities of things like tin and nickel can actually be very expensive as well, and actually cause them financial difficulties, the buffer stock agencies. The third problem is the most interesting one, and it's perhaps the most difficult to understand, but it's the one that you should really learn. The third problem that buffer stock agencies so often fail in their schemes is that when it comes to setting the intervention price, they set it too high. Perhaps it's their greed, but they set the price too high. And as a consequence of that, they spend the majority of their time trying to boost price up to this too high intervention price. So most of the time they're buying and buying and buying the commodity, pushing the price up, and they rarely find that the market has the price above the intervention price. So they rarely get a chance to sell this commodity that they've been buying and buying and buying. So in essence, as the intervention price gets too high, is set too high initially, they spend much more of their time buying this commodity than actually selling it. And so they go broke, because ultimately they end up running out of money, but with vast stores of the commodity, hoping in vain for a chance to sell it if ever the price were to get very high, and they would be needing to push that price down. And what happens then? The buffer stock agency collapses, and all their stores flood the market, and the price collapses again anyway. Very few buffer stock agencies have actually been successful in steadying the price over a long period of time. They fail for those three reasons. Okay, it's buffer stock agencies with their buffer stock schemes. Thank you.